Hey, good morning, everyone. Marty Missouri here, the 19th of December, 2023, Tuesday. This is going to be a super quick market update. I just feel like I need to reach out. I'm taking a few days here, as regular readers have noticed, where I'm not blogging at all, and that's because I'm deep in the weeds with our year-end letter right now. I'm working on articulating our longer-term dollar thesis, which is a very important thesis in terms of what's going to transpire, we think, over the next few years. So those things take time. We get deeper in the weeds than we normally do. And I am therefore using the time I would normally devote just to the daily blogs to the year-end letter. But nevertheless, the market goes on, of course, paying a lot of attention to what's happening. It is the holiday season. We are getting that Santa Claus rally, clearly. And volume's going to get less and less as we go on, as people kind of exit the year, and therefore that can make for, actually at times, for some pretty interesting price swings. But the purpose here is to look at the technicals. We're going to cover the S&P, just the daily chart, just to keep it quick, the NASDAQ 100 ETF, the Russell 2000. Going to look at Nvidia and make a point about small caps relative to some rotation that we're seeing. We'll look at yields. We'll look at the dollar, and we'll talk about sentiment. So just super quick here with the S&P 500. We've broken above what I had there as a rising wedge pattern, and when we adjust that, what do we have? A rising wedge pattern. Actually breaking above this previous high in the MACD. So we're about to the point, unless it rolls over soon, to say that we really don't have a negative divergence here. You would tend to get into these pretty overbought areas, and then you might consolidate a little bit, momentum calms down a little bit with price, and then we're off to the races again. So this isn't quite as bearish from just basically a shape of the MACD, and that is definitely a buy signal, and you can see some accelerating momentum there. Hugely overbought at 81. Okay, and we've done this before. This suggests that a pullback is imminent. Aside from breaking out of this bearish divergence right here, I'll repeat what I've said the last couple of videos, and that is that I would be as bearish here as I was end of July were it not for seasonality. So we'll see when the calendar turns over. I do think there's reasons to be optimistic on stocks coming into the first quarter, or maybe throughout the first quarter. We have a different view as we get later into next year, and of course that can come sooner than later as well, so I'll keep you posted on that. The NASDAQ 100 index, this is that same one I showed you last time. I thought it was worth pointing out that the pattern right here is eerily similar to the pattern that got us to this place in late 2021, right? And that was the all-time high for the NASDAQ 100. We are right there as I speak. Take a look at what the MACD was looking like then. Take a look at what it's looking like now, although a little better as we pop here, but still a very bearish divergence on the Qs. Very overbought, and if I want to go from there, bearish divergence there as well. This is a very difficult looking chart, but again, we could blow right through these things if sentiment holds up. And again, we're going to talk about sentiment in a second. Russell 2000 small caps have been phenomenal, just absolutely phenomenal. And here's where we sit right now, folks, just below the 62% retracement from the all-time high peak back here in early 2022 for small caps. So you can see just literally once we lost that line back in here that now equates to a 62% retracement, we failed virtually every single time. Boom, boom, boom below that, and here we are right now. We don't have some of the bearish divergences though that we had during these other times. Did not have that there. In fact, that was very bullish coming off of here, no doubt about it, and then rolled over, and it's just been quite the trading range right in here ever since. So it's a tough call. Very overbought, right? And when we've been overbought before, that has spelled at least a near-term pullback in the Russell 2000. But folks, what we're getting right now clearly is some rotation. This is the kind of rotation we typically would exploit at the beginning of a new cycle. At the end of a bear market coming out of recession, you do want to own small caps in a size that doesn't make you nervous. And we have in the past, and we will again. Our overall macro assessment says, though, that this is very likely a bear market rally. Whether or not it is, there's some technical resistance we're running into right here. But again, we could break out. And the reason this has been so special, I think, I'm just going to illustrate that with the Nvidia chart, right? So we've had this massive, insane move in anything AI, and Nvidia is the king of AI, of course. The small caps are up 1.5%. Nvidia is actually down 1.5% today. Very different looking charts. So again, we're still right there. So it's not like we've had this massive rotation. But whether or not people are rotating out of Nvidia into small caps, they're definitely favoring small caps over the AI craze exhibited by Nvidia right here. Microsoft is also down a little bit. Apple's pretty flat on the day. As we get into next year, the market is clearly right now buying into this soft landing, no recession narrative, and investors and investment managers are falling all over themselves, trying not to miss the next big upswing. Very difficult situation, and it's going to break a lot of hearts, I'm afraid, if indeed the leading indicators play out the way they look like they're likely to play out. Could be second half of next year. Market will probably discount that sooner, but we'll remain open to all possibilities. But right now, the data that count are not telling us this is a time to let the pigeons loose, so to speak. So we'll keep an eye on all these things. Of course, we want to keep an eye on yields. Remember, the technical pattern suggested that yields were going to burst higher. Fed Chairman Powell did a wonderful job last week of basically convincing markets that it's going to be this immaculate disinflation and we're not going to have recession and we're going to ease up on policy. Whether he actually said those things verbatim or the market interpreted it the way it wanted to, of course, that's open for debate. But we're still in a falling wedge pattern, but we don't really have a really bullish look just yet in the momentum indicators. If we break out on some positive data or some hawkish Fed talk, then we'll have a different conversation. The dollar is down 38 basis points today, had a massive night against the yen. The Bank of Japan decided to not continue its recent threat to end yield curve control, which would be massively bullish for the yen. We had one day where they hinted that. A week or two ago, the dollar was down 2.5% that day against the yen. That's a theme I'm probably going to cover in one of the parts of our year-end letter, because I do think the yen sits very pretty over the next year in terms of where positioning is, what the Japanese central bank has to do, and that actually has implications for global markets if they do end their yield curve control. And we'll get into that in more detail, either in the year-end letter or perhaps in another separate blog post. So the dollar right now still looks bullish based on how we look at the technicals, right? But again, falling inflation, to the extent that the dollar trades on interest rates, that's a weak dollar scenario. So while this does say bullish and there's an upside potential for a bounce, this also looks to me like a bearish flag or a bearish pennant, whatever you want to call that. And essentially what we would do if we do break below there and it's threatening to today, then you would look for a price target that is roughly the length of the flagpole, which would take us down here, which would be pretty good decline for the dollar, get us close to the 2023 lows. I doubt that we'll get there. But if that were to transpire, that's very bullish for equities, at least initially. So we'll see. Stay tuned. And then I want to talk about sentiment. So the American Association of Individual Investors, I pointed this out a week or three ago, and I just noticed here that the spread between the bulls and the bears at a 29.26 is the highest it's been since the all-time peak. And so here we were when the market, or just before the market hit its all-time high. And of course, we had a pretty precipitous drop, and 27% down, peak to trough in 2022. Had it again right before the 12% correction in July. So folks, here we are, again now at these all-time highs, right? And we've got sentiment really out over its skis. The investor intelligence bull-bear spread is in the danger zone as well. And I also wanted to point out, a technician or an analyst who I follow pointed this out this morning, and I thought I'd share it as well. I noticed this when I did the weekly analyses. We look at short interest on several securities, and the Qs, the NASDAQ 100 index, which we chart each video, you can see that the shorts are giving up the ghost. And so that, to no small degree, explains what you're seeing here. So folks, remember, a short is a borrowed share that ultimately has to be paid back. So it's borrowed, it's sold, it's got to be bought back and given back to the lender. So this is when you see short interest going down, shorts are covering, they're actually buying the security. This is also a sentiment indicator, by the way. And then last but not least, I wanted to show you non-commercial traders, i.e. speculators, net positions in futures on the NASDAQ 100 index, which is what the QQQ tracks. So when you see the green, that means they are net long. There's much more bullishness relative to bearishness. Just going backwards here, notice where it was right here at the market peak in July before this double-digit correction. You notice right in here, it was green at the all-time high, right before it rolled over into that 2022 bear market. Notice how green it was, coming into COVID. Actually stayed green, rightfully so, when the market was rescued by the Fed and the Treasury Department. Notice though we were stayed green here, and then we had some correction action in there late in 2020. So I think you get the point, folks. Here we are again, right before a correction. So here we are at pretty high level of net bullishness among future speculators. And so if that flips, of course, then they go short, and that's a sell. And so just basically the point I'm making is that if anybody wonders why we're not joining this party despite the seasonality, it's just because when you put it all together, seasonality is big, and if you're a short-term trader, I congratulate you if you've been exploiting this to your benefit. At some point, either these things are going to have to calm down, either through just consolidation and some sideways movement perhaps, or something meaningful to the downside. I think that's later next year, and I think that's relative to falling earnings based on a weakening economy. That's what really gets this bear market done and over with, if it's not over already. Folks, I'm going to stop right there. Thank you as always for watching and listening, and I'll talk to you again soon. Bye-bye.